So what if I told you that the most important war of the next decade isn't being fought with armies, but with aluminum? That the soda can in your hand, or the canned soup in your kitchen, are actually the front lines of a massive, multi-billion-dollar global conflict. It's this invisible battle for dominance that's going to shape the future of pretty much everything we buy, and it's all happening right now, hiding in plain sight. Let's break it down.
Today, we are diving deep into the 2025 aluminum war. We're pitting three absolute titans of industry against each other: Ball Corporation, Crown Holdings, and Silgan Holdings. And just so you know, this entire analysis comes straight from an incredibly detailed report by the industry analysts at HDIN Research. They've spent months digging into the strategies and, just as importantly, the balance sheets of these giants.
You know, it's funny. Billions of us interact with the products these companies make every single day, but we almost never give them a second thought. But behind the scenes, the metal packaging industry is this incredibly high-stakes arena. It's an essential, non-stop global machine, and the fight for control is getting more and more intense.
So what's fueling this whole thing? Well, it really boils down to one massive trend they're calling the substrate shift. Basically, pushed by us, the consumers, and by new regulations, huge brands, think Coca-Cola, PepsiCo, Nestlé, are all moving away from plastic and glass. And their new favorite material? Aluminum. Why? Because it's light, it's strong, and, this is the big one, it's infinitely recyclable. This one shift is the main battleground where our three contenders are fighting for their entire future.
All right, let's meet the combatants in this war. In one corner, you've got Ball Corporation. In another, Crown Holdings, and rounding out the trio, Silgan Holdings. Three absolute giants, and each one has a totally unique strategy for how they plan to conquer this market.
Just at a glance, you can already see their completely different playbooks. Ball is the revenue king, a pure-play behemoth that's betting pretty much everything on aluminum cans. Then you've got Crown, the diversified player, mixing its beverage cans with industrial packaging. And Silgan, well, it might be smaller in revenue, but it's a defensive specialist, totally dominating the US food can market and these really high-margin dispensers. Their core strengths, what we call their moats, they couldn't be more different.
Okay, now this is where it gets really interesting. Look at how Wall Street sees these companies. If you put $100 in the S&P 500 5 years ago, you'd have almost $200 today. Great, but that same $100 in Ball Corporation, it'd be worth just $60. Yikes. Crown, on the other hand, took a dip but is now climbing back. So what is going on here? Why this massive split? Why is the market punishing the biggest player in what's supposed to be a booming industry? Let's get into their playbooks.
So first up is Ball Corporation, who we're going to call the all-in gambler. In a pretty shocking move, Ball actually sold off its very profitable aerospace division. Why would they do that? To go all in, 100% on aluminum. They are literally betting the entire company on that substrate shift, believing their huge scale and amazing sustainability cred will let them dominate. It is an incredibly bold, high-risk, high-reward play.
Then you have Crown Holdings, which is the total opposite, the diversified strategist. See, they're not just about soda cans. They have this really cool transit packaging division that makes stuff like steel strapping and protective gear for heavy industry. And that just perfectly shows their whole philosophy, balance. They're also crazy efficient. They have the best asset turnover in the game, which just means they squeeze more revenue out of every dollar of their assets than anyone else.
And finally, there's Silgan Holdings, the defensive fortress. Silgan controls more than half of the US food can market. We're talking Campbell's soup, pet food, stuff people buy no matter what the economy is doing. It's basically recession-proof. But their real secret weapon, their hidden gem, is this high-margin dispensing business, making all those complex little pumps and sprayers for perfume and cleaning products. They don't bet on flashy trends. They just buy market leaders and build a fortress that's almost impossible to attack.
Now, these corporate strategies are cool and all, but they aren't happening in a bubble. This whole war is being fought on a new kind of battleground. It's not really about market share anymore, it's about perception. We're in a green gold rush where sustainability has become the ultimate competitive advantage. The winner here isn't just going to be the company that makes the most cans, but the one who can best sell the world on a story of a circular economy.
This quote from the HDIN Research report just nails it. Maximum common denominator. What does that mean? It means aluminum's infinite recyclability is the one thing everyone, brands, consumers, and regulators can all agree on. And for these companies, that's the absolute key to unlocking future growth.
And this is where Ball's all-in bet really starts to make sense. Look at this number, 74%. That's the average amount of recycled aluminum in a Ball beverage can. Now, that isn't just some nice little stat for a press release, it's an incredibly powerful sales tool. When they walk into a meeting with a client like Red Bull or Coca-Cola, they can prove their commitment to a circular economy. And the third-party ratings back it all up. Ball has a perfect AAA ESG rating from MSCI. That's the highest score you can possibly get. Crown is right on their heels with a very, very strong AA rating. In today's market, you have to understand these ratings are basically a currency. They help you win those huge long-term contracts with the world's biggest brands, because those brands are under massive pressure to clean up their own supply chains.
But look, a great story and shiny ESG ratings aren't enough. The HDIN Research report went much deeper. They started decoding the balance sheets. And underneath the surface of these industrial giants, they found some potential red flags. Some hidden vulnerabilities that could seriously threaten their empires.
First up, let's talk about debt. To build these global empires, these companies have taken on a ton of debt. The best way to think about it is like they're paying down the mortgage on a worldwide network of factories. As you can see, Ball is carrying a heavy load, over $7 billion. Silgan is not too far behind at over $4.3 billion. But Crown really stands out here with the lowest and most stable leverage. And that gives them a lot more financial flexibility, especially when the economy gets tight. Okay, so to manage all their cash, some companies use these really complex tools like supply chain finance or SCF. The absolute easiest way to think about it is this. It's like using a special credit card to pay your suppliers. It makes your cash flow look amazing in the short term because you're not actually paying them right away. But here's the danger. The bank can suddenly decide to cut your limit, and poof, you have a sudden cash crisis on your hands.
And here are the specific red flags the analysts found. Ball depends heavily on a similar tool, using over $1.8 billion in what's called accounts receivable factoring. That's basically selling their unpaid customer invoices to a bank for quick cash. Silgan relies on $438 million of that supply chain finance we just talked about. Crown has this weird, unique legacy issue, a $177 million liability from old asbestos lawsuits. And then both Ball and Silgan are carrying billions in something called goodwill on their books. Goodwill is just the extra money they paid for companies they bought. The risk is that in a high-interest rate world, that intangible value could suddenly get written down, which would be a huge hit to their bottom line.
Okay, so we've seen the strategies, the green credentials, and the hidden financial risks. After weighing all of this evidence, the analysts at HDIN Research came to their final verdict. Which one of these titans is actually built to win this thing? Now, before I show you what they decided, just think about it for a second. The all-in gambler, the diversified strategist, or the defensive fortress? Who do you think has the most resilient game plan for the next few years? And here it is, the final scorecard. In first place, with an incredible resilience score of 9.2 out of 10, is Silgan Holdings. The analysts crowned it the defensive king, all because of its unbeatable market share and its steady, high-margin businesses that don't depend on the economic cycle. Coming in at number 2 is Crown Holdings, the efficiency star, getting huge praise for its amazing asset turnover and stable finances. And in third place, despite its massive size, is Ball Corporation, the leveraged pure play, whose high debt and a reliance on just a few big customers creates some real potential risks.
So here's the main takeaway. The winner really depends on what you're looking for. If you want stability and you want to be protected from a possible recession, Silgan's model is the clear choice. If you're looking for a balance of industrial growth and consumer stability, Crown's super efficient, diversified model is pretty unique. And if you want a pure, high-octane bet on the aluminum sustainability trend and you've got the stomach for the risk, then Ball offers the most direct way to play it.
At the end of the day, the company that wins this war won't just be another market leader. They're going to be in a position to literally define the future of sustainable consumer products for decades. So the real question is, which strategy would you bet on? Now, this was obviously a very high-level summary of a really complex battle. For the full 50-page deep dive report from HDIN Research with all the data and financial models, you can head over to their website. Thanks for tuning in.